My name is Anne Derry. I head sustainability for the NCBA group, and I'm thus tasked with the responsibility of ensuring that IFRS S1 and S2 and other regulations are embedded, and that sustainability's place in the strategy is rightfully integrated within our operating model.
Thank you very much, Anne.
Good afternoon to everyone. My name is Christina Randi. I'm the Group Sustainability Manager at Jubilee Holdings Limited. So my day today is, first of all, to demystify what sustainability is. And part of it is integration of S1 and S2, not just as a compliance perspective, but strategically, and to just ensure that sustainability is business as usual and not treated as a side discussion across all our entities. Thank you.
Thank you very much. Christine, to the gender quota representative.
Thank you. This field I've noticed is very much gender heavy towards the ladies. So let me break that. Yes, I introduce myself as a member of ISPAC Sustainability Committee, but on a day-to-day, I am the principal consultant at Libra Consulting, and we are supporting a number of organizations, regulators, in embedding ESG, sustainability reporting, climate risk assessment, the whole of that suite. So thank you.
Thank you very much. Affirmative action, we appreciate. So I'll just jump straight into the conversation. We've had a lot of discussions from the morning session, understanding from even a code of governance perspective. And of course, Christine has walked us through a very insightful session on how to think around governance. And a lot of conversation has come to the ESG perspectives. I really want us to focus on the practical bit, because I think the team I'm seated with here are quote unquote the engine. You're the people that now we ask for, where are we on this, right? When the everyday operations are going. I'll start with you, Christine. From a capacity perspective, ESG has now traditionally always been embedded, whether in strategy or climate risk. What's been the biggest challenge or gap in filling capacity when it comes to ESG integration? Sorry, I meant Anne. Sorry, I can repeat the question, Anne. I meant...
It's all right.
Go ahead, Anne.
For us, there is first of all breaking down IFRS S1 and S2, and I've just alluded to the fact that not only do we have IFRS S1 and S2, which is like the umbrella regulation that's now enforcing the integration of sustainability risks and opportunities from a financial perspective, in recognition of the impact of this on the bottom line. We've recently seen the impact of climate events on mortgages, on infrastructure, on the agricultural bill. We have seen NEMA recently has started cracking down on industries that are along the Nairobi River Basin that are accused of polluting the Nairobi River. So we are seeing these risks beginning to crystallize, and they are having an impact on the bottom line. There is an actual and tangible credit risk from that perspective. But on the other hand, we also have the opportunity side, which is the green finance side. So then, with all these regulations that are there to govern how we are managing these risks and how businesses are managing these opportunities, the first thing that has to be done is breaking down what these regulations are and explaining them to people in a language that they understand. So one of the biggest impediments for me for the uptake of sustainability has been around the science, the technical language. It loses half the room, it loses the leadership, and the minute you do that, that becomes a messy affair. But then number two, there's also the issue of continuous training. And our continuous training starts all the way from the board level to management to everybody in between. We've established, so one of the things we've done, because driving leadership back in is super critical for the enforcement of IFRS S1 and S2. I'll take a step back. IFRS S1 and S2 have requirements. So we've got the 4 pillars: governance, risk, strategy, and metrics. Under those 4 pillars are requirements that have been documented that we need to actually abide by, and these requirements are many. Now, typically, sustainability teams are lean. They tend to be 1 or 2 people. And then you've got organizations that are groups with franchises, with subsidiaries that all need to be abiding by IFRS S1 and S2 requirements. So then now that capacity gap, and so that we have 2 capacity issues: capacity from the availability of resources, and then we have capacity from the understanding of the requirements. So which means it's imperative that sustainability works with other departments. So for example, there's a requirement around ICAP that is being led by the risk department. There is a requirement around scope 1, scope 2, and scope 3, so interfacing with the business teams and procurement teams, and so on and so forth. So establishing working groups is what we've done, cross-functional working groups. We have continuous training for everybody from the top down, but then critically to leadership buy-in, we have engaged with the leaders, the group directors, and the MDs of the subsidiaries, and embedded ourselves in their mancoms, because their mancoms is where, if anything that has the attention of the leadership is discussed. So we've embedded ourselves in mancom, and then we've enforced IFRS S1 and S2 regular reports as part of board and board committee reporting.
That was very thorough, which just a reflection question before we go to Christine. Especially on the subsidiary and group dynamics, because I know even from an industry practice, one of the biggest challenges you have is sustainability teams are sitting at HQ, but you have 100+ branches, and you're asking yourselves, how do we go about managing data, and not just data, because I feel like data is the secondary element. How do you manage the skill? If we are even thinking further ahead to how we are hiring, are we trying to find a mix and a dynamic of such skills coming to the table, even on a hiring capacity?
So I'll give the example of where I work at the moment. So that's NCBA. We are headquartered in Nairobi. So the Kenya business is the group, the HQ. Then we have Tanzania, Rwanda, Uganda, and that's the physical presence. I'm not going to talk about the virtual presence for now. In addition, we have subsidiaries.
So sorry, maybe I could give you my mic.
In addition, we have an insurance subsidiary, which is NCBIG, and there's a reason why I'm mentioning them. And then we've got the investment banking arm. All these are required by ISPAC in Kenya. Then we've got ISPAO, ISPAR, and NBA in Uganda, Rwanda, and Tanzania, who have each given different timelines for the implementation of IFRS to abide by IFRS S1 and S2 requirements. Christine said something that's super fundamental. It is making sustainability BAU. So what you do, first of all, because you have limited resources, and the truth of the matter is you may want more people, but it's not going to be possible. For us, we do have sustainability leads, substantive sustainability leads in each of these markets. So that's the first thing. So that helps a lot. But then the skill sets you'll find are largely and heavily in the group. So we do a lot of skills transfer, regular skills transfer, regular trainings for those teams, coordinating for them and working with them very, very closely to ensure that all of the sustainability, whether like you're saying it's IFRS, whether it's green finance, whatever it is that we are pursuing, is being done according to the level that is auditable, because today these regulations require us to have auditable data. And then from there, I think the final one is working with the rest of the business, like I mentioned earlier, is map out. You see, sustainability is like, I find it like customer experience risk. You map out what different deliverables in everyone's BAU align with sustainability. So if I give the example of green finance is selling. You go out and sell loans. So just work with the business teams is to educate them and empower them to understand what a green loan looks like without going into too much detail, consistently working with them on mapping our books and pitching for ideas, and then doing the work in the back end. So it's a continuous, it's a lot of upskilling is what we're doing right now.
This is very extensive. I think eventually we will start seeing discussions that are going to the consumer around sustainability and ESG, because I feel like at the moment a lot of it is being driven by regulation, eventually now going to the market. In the next panel, perhaps discuss how the market is taking up some of these interventions. When you tell them we can no longer finance XYZ, taking it to you, Christine, and I know the other Christine has also talked about governance. We didn't plan, but she'll also be touching on governance. The tone at the top, right? I think we say it, and sometimes we assume we all understand what the tone at the top means like. From a very practical lens, how has governance really supported embedding ESG? We could do all this other work in between here, but if there's no organizational buy-in, we're kind of stuck. What has been the experience to getting the most organizational buy-in in your work experience?
Thank you for that question. And it's very, very true that most of the time we talk about environment aspect, the E pillar, the S pillar, we forget about the governance pillar, which is very critical. And from where I see it, I think it's the glue. And as Christine said, it's also, as in that's what builds, that's the trust. All our investors and stakeholders are looking at our governance, and that's where they're basing our trust on. So from my experience, it was very critical. And here we are coming from an aspect where we began early adoption of ISSB standards, starting with Tanzania, because we have an entity in Tanzania. So in 2025 financials. So we had to report, of course, taking into consideration the reliefs, because we are all starting. But the key thing is, after all the capacity building sessions that we had, after all the notes that we were given and presentations, the most difficult thing was making it practical. What is in theory, and then you're told to do it practically, honestly, is not simple. And we realized we don't have to start with technology. We don't have to start, looking at frameworks. We need to address the people aspect first, and we need to address governance. And that's where the top leadership comes in. So we are looking at where leadership used to discuss matters to do with sustainability when they're just talking about CSR, or planting trees, and that is sustainability, right? We are seeing that the data that you need for you to report is fragmented in different departments. You need environmental data, you have to go to the facilities teams, you have to go to the property team, for example. You need HR data, you go to HR. You need customer metrics, you go to different business units. You need matters to do with governance, you have to talk to risk, you have to talk to legal, to governance. The data is fragmented all over the place. And beyond that, this data that you need has never been audited. So we are used to only having financials audited. So we have data that is in different forms, not consistent, scattered, and it's not assurance ready. So there was quite a bit on that. And how we started and the wins that we saw is, first of all, creating literacy for the board to understand, and the management, that sustainability is not just CSR. There's more to that. There are a lot of sustainability issues that are happening that are affecting, and I'll speak from my experience in insurance, that are affecting, that are giving us very high exposure in terms of underwriting risks. We have sustainability issues that are just changing all that we're used to in terms of health trends, because we have a health business. This is where claims is going to be hit. We have sustainability issues that are affecting our investment portfolios. And now the business has to start thinking in a smart way, in a strategic way, and sustainability became an exercise for business transformation. So a quick win for us was to have board appoint a sustainability task force fully dedicated to matter sustainability. So what do we need to do? Who needs to be accountable? What kind of data do you need? What are the gaps that you need to do? And there was change. We had to start working cross-functionally with teams that we've never had to work with. Finance became receptive to sustainability, and now when we talk budgets, they begin to understand why sustainability needs a budget. Initially, sustainability needed budgets for, as I said, CSR and tree planting. But now they began to see that there's more to this, yeah? So that's cross-functional collaboration. training, but enforced from the top. So board literacy was very critical. Management literacy was very critical to drive this decision. And I talked about us being in different entities. Maturity levels are different. Kenya is not at the same level as Tanzania, not the same level as Uganda, not at the same level as Burundi. Regulatory expectations are different, therefore operational priorities are totally different. But once all leadership was able to speak the same tone and understand, things started moving. We all knew we are heading to one specific direction, without, of course, compromising our locality priorities. So once leadership came on board, and what helped in that first journey that we had with Tanzania, and we are progressing as now Kenya is even bigger because our holdings resides in Kenya and also Uganda, is we began to see we were getting data much faster. Guys were more receptive to understand what type of data, or we need training from the point of the kind of data we are capturing. We began to see as well sustainability being prioritized, where CEOs of different entities are asking, we don't have a budget for sustainability. Do we need to get external resourcing to support us in capacity building? We need to prioritize. And that is because of that governance perspective, and they were able to understand. And regardless of all the differences, the common thing was we had one vision, and leadership was driving it from the top.
I think the key highlight here I'm picking is having a budget is a really good place to start. I mean, I think a lot of people will be talking to you on the side as to how we can drive the budget conversation. And a key one that you said, that finance was finally starting to understand. And I know it might seem like it's very obvious, but in the insurance business, until you are having conversations around underwriting and claims that's tied to ESG considerations, then you're having audience because it's a core imperative of the business. These are really good aspects. Finance. I know, Patrick, you've been a CEO for as long as I've been alive. So to bring this context home, you are the people who don't give budgets. So for a mid-sized company that is transitioning and is thinking around adopting IFRS, as Christian has said, the maturity levels are going to be very different across all these entities. We have early adopters, we have ones that are thinking of compliance, and then we have others that are thinking from a very strategic point of view. Paint a picture of these maturity levels from a CEO perspective. What are some of the key highlights that should be focused on?
Thank you. Yes, different organizations are at different levels of maturity, and therefore the journey towards implementation is expected to be different. My first point is that IFRS S1 and S2 are not looking to make organizations experts or award winners in reporting in the first year. IFRS S1 and S2 have what we call proportionality considerations. Their reliefs, their what can we say? We can talk about IFRS has very many proportionality interventions that focus on those entities that may not be able to invest in data systems, to invest in capacity. And what IFRS tells you is that don't spend, or yes, budgets, yes, but don't spend more than the value that you're going to receive from that information. Don't go out looking to invest in systems, to invest in very heavy capacity that probably may not be necessary at the onset. And I think the very first thing that organizations at whichever level is to understand your business model. What is it that you do? What are the risks and opportunities that are faced by your business? What from those risks and opportunities, what are the significant ones? Don't start looking at emissions, and probably they are not significant for your business. Maybe you do not have significant emissions. What are your material topics? Then move further to thinking about a baseline assessment or a gap assessment. look at the various pillars of governance, strategy, risk management against your current processes, against your current reporting practices, against your people capacities, and ask yourself, where do I have the gaps? And then start working on those gaps. Christine has talked about buy-in at the top. Without that, you may not go very far. These are the people who will approve the budget. These are the people who are going to approve your requirements, and then you take it up from there. Many small organizations are starting to focus on templates. They are starting the conversations around data, starting to collect data when they've not identified what do I need to report around. So you go do too much developing templates, collecting data that probably you might not even need at some point. And of course, getting assurance ready is also important. I know assurance is about a year or two further after adoption, but we need to start getting ready for assurance. Assurance, you don't get assurance ready at an instant. It is a process that starts with setting up the policies, looking at your data on a periodic basis, ensuring there is internal assurance of your data before you even look at external assurance. Data controls, validations, ensure that all that is in place. Capacity, build capacity of your teams, finance teams especially. You have to go back to the basics, understand sustainability, because it is not for the sustainability team. It is for us as it's a multidisciplinary objective. So all of us have to be roped in and do what we need to do. Thank you.
I want to throw an interesting perspective that probably I didn't put in our prep notes, but just from an opportunity point of view, I think one of the biggest conversations we have in terms of opportunity is, of course, there's a political ideology around sustainability and ESG, and there's a lived reality of climate risk is here, and we're not just dealing with climate risk and environmental risk alone, we have the social risk and the governance risks. I want us to paint a picture of how do we actually operationalize disclosures to unlock opportunity for us. I know there's a banking perspective and there's an insurance perspective. And we're talking to investors. We have retail and institutional investors represented as here. You sit with the data that informs a lot of the transaction advisory work that goes into the prospectus. Paint for us, so far in your journeys, at least for Anne and Kristen, with the different sectors in mind, what the opportunity has looked like. Having gone in, set up the structure, set up the governance, set up the data, what are some of those early, quick opportunities that have come courtesy of compliance?
In terms of opportunities that have been there, so there's quite a bit both. I look at it from both internally, in terms of us adjusting and being ready, and I'll also look at it externally in terms of product innovation, opportunities that have come up, and what we began looking at. So internally, what it triggered when we started talking about the climate-related risks, the impact that they have in terms of our underwriting, it's made our actuarial teams wake up, to be very honest, and start looking at the aspect of pricing. In specific products that we had, they need to start looking at how they're pricing and the type of premiums we have to charge in case, for example, floods happen. In case there's, I'm talking about floods because that was the most recent. In case we have droughts happening, what impact will that have on us as a company? So that has made our actuarial team be more conversant and want to start looking at it more with this new lens as opposed to the traditional lens that we had. And the other thing that happened as well is relooking at our policies across and make necessary adjustments to integrate the environmental and social considerations, so that then that makes it easier for us to roll that out in terms of just the ERM, the Enterprise Risk Management Framework, how we are doing our business on a day-to-day basis, the operations, the underwriting. Then I look at products. So there's been trigger in terms of the kind of products that we are rolling out to, one, address the masses that are not able to afford the regular insurance. So both from a health perspective and also looking at from a climate perspective. So there's talk of parametric insurance, for example, or parametric crop, where that is triggered in the event that there's a flood that happens in a specific area and it's at a certain level. There's issuance or claims are paid out at a faster rate, more than the usual like flood insurance products that you have, so that the people in that area are able to pick up and address the day-to-day gaps, because their reliance is either on the crops that are in that place or the livestock. From a health perspective, the other aspects we're also looking at health preventative, in terms of creating a preventative lifestyle. So we have a fully fledged wellness docket that is able, of course, with confidentiality and the right expertise that we have doctors and nurses, are able to look at and study patterns and preempt. So key thing could be...
Sorry, Christian, for just to throw in there, as you're giving us these opportunities, these have fundamentally come from adoption, from the kind of data that we were working around sustainability and IFRS over time. These are opportunities that we've now been able to map and tap into.
Yeah, these are opportunities you're able to map, and you realize we have data, and you cannot be able to get this based on 1 year data. So at some point we had a team that has to go into even archives like 2-3 years back and study patterns to be able to then come up with a decision and just give us that guidance. I can't say it's still mature. We are, what is it called, maturing or emerging or growing, but that is just an indicator that there is opportunity. It's not just addressing the risk perspective, but there's opportunity for that product innovation. There's opportunity for us to enhance and cushion ourselves against catastrophic risks that are happening beyond the business.
I don't think I want to add on top of that. That was very, 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 very explorative. And if you bring us back to the banking sector, financing is big. I know we've had from an insurance perspective, we would like to see what the opportunities look like from a financing perspective. I know the unique perspective here is that the opportunities that are coming from the market and that the opportunities that the bank is presenting to the market. We would like to hear what the balance has come from having access to this data.
All right. Last year, the Central Bank of Kenya released 2 guidelines or regulations. The first one is the climate risks disclosure framework. The second one is the Kenya Green Finance Taxonomy. Now, so this enforce IFRS. They're part of the IFRS S1 and S2 umbrella. So in the process of reviewing our data, especially because the data conversation is really big, like Christine mentioned, there are gaps. There's data disaggregation sitting in all sorts of spaces. There's also data unavailability. But as we have begun to enforce the implementation of these 2 regulations, and I'll mention 2 examples for the climate risks disclosure framework, and one for Kenya Green Finance Taxonomy. The climate framework, the climate risks disclosure framework, in addition to the way we book our loans, and in response to climate risks, the central bank, which is really prudent, I must say, now requires financial institutions to map 2 things. You must map where your facility, so if a company comes and borrows a loan and invests that loan in Kisumu, you must map that loan to Kisumu, and I'll explain why. This is for immovable assets. And then number 2, they have also asked us to map all our collateral, our security. Why? So that we can determine our exposure to climate-related risks. So you may be holding, as a financial institution, collateral that is exposed to floods. So is that collateral really at the true value at which that is in your books, or what is the risk to that? We have El Nino that's about to come up. There are very many forecasts that El Nino is coming up. So now, as a bank, we've begun to review, even when we receive information on El Nino, we've begun mapping our books to say, where is our exposure from our existing book, both on the facility side and the collateral side. But even going forward, relationship managers as you go out and get business, ensure that the sustainability team reviews it from that perspective to ensure that if we're given collateral, and because we have data, we have more data than we did a couple of years back, especially on areas that are prone to flooding, it would be remiss of the business to accept collateral that will likely be flooded when we have data for the last couple of years, having seen what is happening. So now the environmental and climate issues become hardcore business conversations with an actual financial component to them. Then there's the Kenya Green Finance Taxonomy, and there's somewhere I'm leading with the opportunities conversation. The Kenya Green Finance Taxonomy is a framework that has been developed by the Central Bank of Kenya in concert with the European Investment Bank. And in essence, it is the criteria by which we define what is green. So today, we have different, if you go to Bank A and Bank B, we all claim to have a green book, but how Bank A defines what constitutes a green portfolio is completely different from what Bank B defines it as. So now with the central bank's taxonomy or criteria, we now have a standardized way of addressing green. Why is this important? Two things. Number one is that it gives us criteria for what actually is green. So there are specs and there's carbon emissions and, there are all sorts of criteria that go, technical criteria. But then number two, and for me this is critical, is to ensure that, for example, say we are financing an organization that is in the solar space, but then in the manufacture of their solar panels, they are A, spewing waste into the environment, B, they have disenfranchised a community, they've displaced them, C, they are not paying their employees well. That negates its greenness. So green is not just green because it's solar, because it's an electric vehicle. It is the what and the how, and I think that's super critical. So now in the review and the opportunities that have come up, they're two-pronged. Internally, we have identified our data gaps, and it's important for us to use a certain phrase here, which is called business useful data. So when we have, like I've just mentioned, now we're able to tell which part of our collateral, what percentage of our collateral is exposed to climate-related risks, so that we can put in place the requisite mitigants. So it has given us, so there's that internal opportunity. The internal opportunity around how much data and what is the quality of data we are collecting and what do we need to do. The opportunity around enhancing our systems. We would like to have a single source of truth. The single source of truth that says this is client X, this is how much we have from them in terms of assets, loans, this is their deposits, this is what they've taken in insurance, and this is what they have under green finance, this is what they have under working capital. Like if you throw at me that one client, I can see their totality, or their profile in totality, and whether they've undergone, for example, for the corporates, an environmental and social due diligence audit to ensure that they are doing their businesses in accordance with the law and the right and governance perspective. In closing, from a business perspective, I've just mentioned that we had NEMA going out, and it's still going out, to identify companies whose effluent discharge systems are inadequate or completely non-existent. We have seen and even witnessed when at the height of the rains early in the year, and as we go into the next phase, we've seen some of our clients being impacted. So now we go to them with solutions. We go to them with solutions around how can we help you adapt to these climate issues. You are our farmers, you're in the agriculture space. How can we help you, with the right farming methods, whether it's to adapt to drought, adapt to floods, how do we invest in your mitigation activities? So in essence, with that now, because it's more detailed and there's a lot of data that we have available to us, we are actually able to make smarter, sounder business decisions.
I think other companies that are benchmarking are asking themselves, there's a lot that's already happening in the market. How do we actually go and start benchmarking here? I think two key things that I've liked with how you've drawn the approach. There's the findings that are coming from within the bank, and then there's the opportunities that we're taking to our customers. Because I think sometimes when companies are grappling with the question of compliance, is you're asking yourself, how does this actually help our customer base? And we're seeing opportunities that are actually going to market and serving our customer base. Patrick, I'm going to bring you to your CFO days. because I know we have a couple of investment agencies and entities in the House. Anne has mentioned something very critical. I know we were working on the taxonomy work with the Central Bank of Kenya, and some of the key things when it comes to portfolio mapping and just understanding where our assets sit and the valuation questions. We're talking about opportunities, and the biggest questions that come often when you're pricing is how valuation has done. Are we seeing an opportunity in the near future where actually how we've integrated ESG and mapped our portfolios will eventually start heavily informing valuation questions? And this is tied to how you price the instrument you bring to market.
Maybe before I go to the question of valuation, just to piggyback on what Anne has talked about, the Kenya Green Finance Taxonomy and the Climate Risk Disclosure Framework, which I had the privilege of being part of the team that developed under the European Investment Bank Technical Assistance Program. And I can already see a few members here who are benefiting from that program. Talking about the opportunities that are there, I think most of the times when we talk of sustainability, we tend to focus more on risks, but there are immense opportunities. And some of these banks that are being supported by that program under two main work streams: climate risk management enhancement, and green finance and opportunity enhancement. We're working to identifying the risks and turning some of those risks into opportunities. Think about an organization that is exposed to transition risk because they have a big fleet of high emitting vehicles. That presents a risk to the bank in the sense that if there was to be a regulation that says that there are no more this type of cars, and that is what you have in your fleet, then defaults start to manifest. So how can the bank now turn this risk to an opportunity by financing this client to be able to invest in more less emitting or more carbon efficient vehicles? And there are very many examples of how to convert some of these risks to opportunities across many sectors. European Investment Bank has pledged, I think about $1 trillion or more by 2030 in green finance, because they are also doing their transition. They are moving away from brown or carbon-intensive investments into clean assets, and that's where that money. That's how they are able to move that kind of money that way. So the Kenya Green Finance Taxonomy presents its opportunity side of climate risk, and we need to see what projects are in there, and whatever sectors we are in, there are about 11 sectors, we can be able to see where opportunities are abound. Coming to portfolio mapping and valuation, and I'll talk this with the nexus or again around climate risk. And Anne has also talked about banks now mapping their assets to locations. Why is that important? Is because certain locations are prone to certain risks more than others. The river, for example, is prone more to flooding. So if you have an asset, in the river, then you start thinking about is the value that I'm holding for that property right? You may start to think about devaluing or looking at the right value. If it's a bank portfolio, the more a certain sector is exposed to climate risk or even other ESG risks, it could be those controversial sectors that have, say, for example, forced labor or modern slavery. How does that affect the portfolio? With intensifying regulations around ESG, with organizations being now more and more putting a bit more scrutiny on ESG performance on these organizations, it means that that portfolio also is exposed to risks, and therefore you need, if it's on the banking side, you need to start thinking about higher provision and performing loan provisions because of the risk that the ESG risks present to that portfolio.
I think there's more opportunity to discuss opportunities for sure, but unfortunately our attention span has maxed in our half an hour discussion, so I'll just ask us to give a very quick parting shot as we close. I think I'll start with you, Christine, and then Anne. It's a quick parting shot. As you can see, my master of ceremony is very ready to clap for us.
Top buy-in, I'll still stick with the governance perspective. Top buy-in is very critical. It's either what accelerates sustainability implementation, not just the reporting. It can also be the biggest barrier. So it's either your biggest accelerator or your biggest barrier. So choose your war. Right? So if you decide that you want it to be your biggest accelerator, what do you need to do? And when you're starting out, the best thing that I say that you need to start doing from a sustainability angle is to look at do a baseline assessment, as Patrick indicated. You talked about understanding our materiality. Don't start just from anywhere. What is material in a different entity is different to another entity. So appreciate where you are and get a materiality understanding. And finally, focus on your governance structures. Ensure that you have a solid governance, because this governance is what is going to determine whether sustainability becomes peripheral or is part of your business discussions and day-to-day transformation of that business. So that's my parting shot.
Sustainability, like everything else, is about relevance. Be clear on the business case that you're presenting. What works or what is relevant, for example, for Jubilee is not necessarily relevant for NCBA. However, the sustainability risks and opportunities, like I've just outlined them, and we are all living them. Whether you're calling them sustainability, whether you're calling them business, it doesn't matter. We are in an era where these opportunities and risks are crystallizing. As long as you're clear on what these are and the impact they have on your bottom line, then define very clearly who needs to do what as part of their BAU. The most important thing, yes, I think leadership buy-in is super critical. I believe one of the lowest entry points for leadership buy-in is the C-level compliance. Very few leaders want to be found on the wrong side of compliance. But then moving it to strategy is about making a business case. For me, sustainability is about breaking it down and making it easy to communicate. Like I said, we do a lot of science speak, we do a lot of NGO speak, and we lose the room. Sometimes because we don't know what we are saying, sometimes because we want to appear like we know a lot, but I think, and sometimes because we're not very good communicators. So ensure that you can communicate the sustainability message very, very clearly to your leadership. Bring it to the front, ensure that everybody gets to understand. For us, I'm finding that these NEMA issues have become a blessing in disguise, because now the conversations have shifted to these are potential risks to folks. These are actual risks. We've even mapped out our potential exposure because of NEMA. So I think it goes without saying that sustainability is now here with us. How you treat it really is boils down to how you value and how you understand it.
I promise you next time they'll give us more time. We're finishing.
Thank you. Mine is to encourage you that, yes, these are new standards. They sometimes feel very complex. But I think we've been there before. In my previous life, we had a very difficult IFRS 17. Those who are in the insurance industry understand the complexity of IFRS 17, and we hacked it. So these two standards and many others these are the inaugural standards. Others are coming. They will not defeat us, but we need to start now. If you've not started, go do a baseline assessment. Go and start talking to your the governance leads, so that we can all of us move together. When we all move together, it's much easier, because as a bank, when I want to finance a manufacturing entity, when I ask for their report, I'll look at their exposures, and it will become easier for us. And of course, there is that question of as we become more transparent, we are able to invite capital and probably better priced capital. Thank you very much.
We have come to the end of this panel session. I think the only takeaway I'd give as a moderator, at least for all the clients that we deal with lately, is you have to critically think around technology and artificial intelligence. I know we like how fast our outputs are going, but then it means a lot of cybersecurity concerns are also coming in. And also, critically, we have to think around automation. The outputs that we're getting, how can we validate and actually automate them in our systems? It's been a pleasure hosting the panel, and until next time, thank you very much.